FOMC week is here. We're going to get into whether or not we're going to get a surprise cut. We'll break it all down for you and how it affects the stock market. My name is Paul Barron. Welcome back to the show. Let's go forward today. I do want to take a look at what's happening over on the Kobe EC letter right there. Fed week is here. Kalshi sees a 95% chance of no change in interest rates this week. However, everybody is looking for potentially 2 rate cuts expected. Now, I'll give you my prediction here in a minute because there are some things that are leading into this that I still think have not been completely uncovered. Now, whether or not Chair Powell and the Board of Governors will agree with that is still the big question, and we'll know tomorrow. We'll be doing a live stream for you guys. If you haven't subscribed to the show, do that, hit the little bell. That way, when we go live tomorrow, you're going to get notified, and you'll be on the cutting edge of any kind of movement in the market. Here's Poly Market still holding a very high percentage right now at 98% flat, no cuts. Another push forward by the Fed. Now this is, of course, for the July 30th meeting. If we take a look at the September 17th meeting, we're holding at around 55% on a 25, which is interesting because it's continuing to edge up slightly. As you can kind of see it starting to move right there, but 55% on a 25 basis points cut. And I want to go to a clip real quick because this gets into how the market thinks this is going to take place. Take a look.
You know, the fact of the matter is there are a number of disinflationary forces that are going on here. Growth is sluggish. There's a regulatory review, should be disinflationary. We have an AI boom, it should ultimately be disinflationary. You have goods overcapacity around the world. Against that, we'll get more resolution, and we're about to get more resolution on what the tariff rates will be. Those will certainly increase costs. The question is, will it lead to persistent price pressures in a disinflationary environment? And the truth is, for this meeting, I think they're not sure. I wouldn't be sure either. But I think they're going to direct attention to September, and I think you'll see them try to be balanced. And I think they're going to, if I were in my old seat, I'd be pushing my team to try to come to some judgment on that by the September meeting, which might cause me to act.
Okay, so good statement there at the end, might cause him to act. But at the same time, this is a ex-Fed guy talking about current Fed guys doing regular Fed guy stuff. So are we getting any really good news here? I think the real question is whether or not there's been enough pressure on Powell to cause for an indicator from a move percentage. And whether it's a situation where he cuts tomorrow or if he says, yeah, we're going to start to work this in, we believe we've got control of inflation. If you take a look at Trueflation, just a quick look, right there, still holding around 2%. That is the target that Chair Powell keeps talking about. Remember, it has dipped as low as 1.2%. So if you look at Trueflation and you consider the rest of the world who is cutting, it's interesting that we're continuing to see this pressure coming out of the Fed right now to hold this position. I want to go to another clip because this is Goldman Sachs talking about the November alternative. And when you look back at the November cut and compare that to where we are now, did they have control then? Well, this will tell you a little bit more. Take a look.
Last time they cut rates, long rates went up. So it's almost, we get the opposite. That's the last thing you need.
The long rates didn't go up because the Fed cut. Long rates went up because there was a rebound in expectations of the economy. Trump won election. There was a view that growth was going to be much higher.
The point is the same. The Fed cut rates, and it's just proof that they don't have control of the long end. The Fed is not all controlling.
And maybe it's a political sense that, the president's going to put somebody else in this role in May and that they're going to lower rates, and that by lowering rates, we're going to be able to buy debt at a lot lower prices, and that mortgages and everything else are going to be a lot better. It's not clear to me, given where we are in the, wherever you think we are in our economy, that, as Becky just described, that they can actually control at least the long end of it all.
They can't. The Fed sets the shortest term rate, the Fed funds rate, and the longer end of the curve is much more a function of supply demand of treasuries and prospects for future growth. And you could just as easily see the curve steepen if they cut. Also, the reason the Fed isn't cutting is not because of Jay Powell. The reason the Fed isn't cutting is there's not a consensus around the table that it's time to cut.
All right, so you can see what it appears to be is still a lot of confusion as to how they're going to play this market forward. My prediction is this, first of all, I'm much higher on the percentage of being able to get a cut tomorrow. I would still put it at around a 60, maybe 70% chance of getting a Fed rate cut. In other words, we're not going to see a pause at about that rate. Looking forward, though, I still think September is the target. And I go back to my thesis around retail. And the reason I say that, retail sales and also businesses in general are going to be looking into the holiday. Now that we're approaching third quarter, we'll start to see a lot of activity moving into that final quarter, which is huge for retail, a lot of commerce. And this is something that is very critical. If we don't start seeing a little bit of easing in the economy, then this is going to be an issue going forward. If companies are capable of going out and getting debt at a lower rate, they're going to hire, or give raises. Those are the kind of things that will affect markets immediately. So September is a really critical time. If they can at least give a little bit of indication that September might be the window, then I think it is a win coming out, and it will be very positive for the markets. Let me go to this tweet right here by Kobe Easy. They're talking about, the growth that we saw in the S&P. This was back in cap gains in 2021. But if you look at the percentage here of the S&P 500, 70% of that came from the 10 largest companies. So if you invested 100K, in the S&P 500 back in 21, 37%, you'd be of the 70,000 return would have come from those 10 stocks. So that's a pretty big deal, considering that there is still a concern by the Fed for the rest of the market, because right now it really is a handful of stocks that is starting to carry this. But we are at all-time high on the S&P 500. Remember, liquidity into risk markets come out of those kinds of gains. That's the thing that I still think starts to feed the market for risk assets, is that liquidity and also the amount of M2 money supply that is available out there. If we get any kind of reprieve coming in from the Fed, I think that's where we start to see things shift a little bit. Big moves ahead. Other things I want to hit at right here, the stock market rally, making history. S&P market cap right now relative to disposable personal income is adjusted for inflation, record 28x. So still very, very strong. And this comes as the S&P rallied 116% during real disposable income that had increased by just 13%. So what I'll say there is this is mostly structured capital that's making these gains. It's not a lot of private investment, but we are seeing retail starting to wage into this. I think more importantly is we're seeing retail continuing to push into risk assets, because I think that's where the next generation still sees growth coming. But all this really ties into whether or not all of this is priced in from what has been happening, and that is these tariffs. Are we still looking at a lagging potential impact on the U.S. economy from all these tariffs? Here is a couple of analysts taking a look at this. Take a look.
It's been interesting to watch the market rally to record high after record high with these trade deals announced, because yes, the U.S. appears to be getting a great deal in all of these ultimate deals, but what we're also getting is higher tariffs coming in that are going to be more permanent, and eventually, isn't that going to hurt growth?
It's definitely going to slow down growth in the coming quarters. Look, the tariff level right now is about 15 to 16%. You take that level of tariff for $3.1 trillion in imports that the U.S. has. That's about $400 billion, which you could say is a tax on businesses and consumers eventually. So I would expect the economy to step lower to a 1 to 1.5% like growth over the foreseeable future.
Is the market just underpricing that?
I think it is. I think there's some key risks there. I do think the market is now beginning to look ahead and thinking about the potential for Fed rate cuts. It's seen that the impact of these tariffs on inflation is fairly muted, fairly moderate. It's willing to look past any uptick in inflation in the coming months, and it's looking at the Fed and saying, okay, if the labor market is truly cooling, let's get going. And it's looking up to 2026 as well.
All right, so a few things there within it. Whether you look at the market in general and how the S&P has been performing, you could make the assessment that, yeah, they're pricing in some of the fact that there's a potential rate cut. But I think the real cornerstone of the American economy is small business. And small business is the one that's being affected the most right now with the current rates. And if we get any kind of indicator that we are going to finally see a little bit of rate movement, then I do think we're going to see positive GDP growth, because I think it's going to move into the rest of the market. That's the variation, I think, when you look at versus what people are doing in the S&P 500 and how they're investing in small stocks or micro caps, even risk assets to a certain extent. All right, here's another 754 bill. This is under assets under management that are looking at continued surging stock prices. That most likely will be the case if we get a little bit of an indicator from Chair Powell tomorrow, which I anticipate will happen. If we don't get a cut tomorrow, then I think he will give us a little bit of a light at the end of the tunnel, and I think that starts to move markets forward. A couple of points that they hit on right here. Next 3 to 4 weeks, I think we're full steam ahead for the equity market in particular. Just as many of the worst case scenario risks have not materialized and are not likely to materialize over the next few weeks. And this goes back to skyrocketing inflation anticipated from all these tariffs coming in. And this may end up stretching it out over time when we start to see this actually flow into the markets, because we still do not know how these suppliers and the retailers and or companies are going to affect that tariff into the economy. Because if you have a pressured economy, it's very difficult to be raising prices. And I think even, Walmart's gone on record, Amazon's gone on record where they would probably not take price. Many of the restaurant chains out there are now at a very, very difficult point because they're worried about taking price right now after been taking price for the last 2.5 years. So, and I say taking price means price raising. So this, I think, still starts to stretch out a little bit further. Here's another bullish signal right here. This is, of course, Tom Lee. And if you haven't been following the e-treasuries, go back and watch some of our videos on this. We've done a few. And some of the things that you have to watch is what he's doing from a strategy standpoint. One is he's buying back $1 billion in stock. So that in itself is probably going to help adjust BMNR, which is the stock ticker for BitMine. The others to watch, of course, are SharpLink Gaming. That's SBET, Joseph Lubin. We've seen all the movement there. BTCS, we've seen that. We've had Charles on the show. A lot is still moving in this direction. Now, Tom Lee is, I would say, is an ETH perma-bull. He is very, very positive and very, very bullish for where the market is heading. And whether that is institutional capital continuing to push, because remember, ETH ETFs continuing to climb, or if it means we're going to see a reprieve on rates, which will bring retail, possibly mid-caps back into the market, mid-cap investment back into the market. So if you look at the stocks right now, I'll just go back and take a look. There's Master right there, MicroStrategy. Then you can go into BMNR after a big drop right here over just the last little bit. I'm on the 4 hour. And then right there is SBET after its decline. Again, these might be good considerations right now. Just, pay close to the MNAV, which is basically their value to their overall holdings of what their assets are. The other one to kind of keep an eye on was BTCS. This is the other one right here. Right there, still trading around $5. So somewhat sideways on that one. Things to kind of keep also in your mind is how are these companies strategically moving? One of them is a good example right here. This is Linea. Today we're setting a new standard for ETH Layer 2, introducing native ETH yield. And this is something I think we'll start to see connecting to these kinds of treasury companies, meaning they're going to start building other products that are actually revenue generating other than just holding the core asset, which is what kind of we've seen against MicroStrategy and Bitcoin. Okay, another consideration here, if you look at Linea, they're talking, this is Ethereum's largest ecosystem fund. What they're talking about doing is two is going to be locking up. That's going to create some supply demand, and then also doing burn. So this all is very bullish for Ethereum, and then also potentially these treasury companies that are playing in it. Because remember, that's traditional capital, and a lot of people who have not invested maybe in ETFs or even the direct asset before starting to look at that. Now, Trump's group, if you look at World Liberty Fi, they've also bought more in Ethereum, so that's another advantage, even though it's only $1 million more. Point is they're continuing to double down on what their holdings are, which pushes more strength into the ETH ecosystem, which is what we need for an altcoin. If there is an altcoin season, ETH will most likely lead that out. Other points I want to hit at right here, new all-time high, 17 consecutive days positive ETH inflows. This just shows the ETH ETF continuing to perform, much like what we were seeing with the Bitcoin ETFs over the past several months. Has that finally rotated into ETH for traditional and institutional capital coming into this? I want to go to one more clip here because this is Matt Hougan talking about that very thing that ETH is creating, maybe a season for TradFi. kind of like an altcoin season. Take a look.
Earlier this week, there is a demand shock. I mean, I wrote about this on Twitter. Since May 15th, companies and ETFs have bought 32x the new supply of Ethereum. We love to tie ourselves in knots. Is Ethereum driven by discounted cash flow? Is it a store of value? None of that matters if these two forces are buying 32 times the supply. So I think it's as simple as that. I think it's going to continue. We've done 4.4 billion in inflows into ETH ETFs this month. And I hear it in my meetings. Everyone wants to talk about stablecoins. Everyone wants to talk about tokenization. And that leads them to wanting some Ethereum alongside their Bitcoin. So this is going to ramp to the end of the year. And I think that's exactly right. People made a ton of money on these Bitcoin ETFs, right? 36.
And Circle.
Well, Circle was the first alt season, but I agree. It goes from there. They made all this money. All this money flowed into Bitcoin. The price went up, 140%. And what are they going to do? They're going to rotate into like Kellogg's? No, they're going to rotate into Circle and ETH and treasury companies, and now ETH treasury companies, and now Solana treasury companies. It's alt season in TradFi for sure.
Okay, so I'm in total agreement with Matt there, and that is that we are going to see a lot of funds coming into the ETH ecosystem, whether it's in through Circle, whether it's in through stablecoins, whether it's in through direct asset or these ETH ETFs, even the strategic holding companies. All of this is good for Ethereum in general. Other things that you have to consider, and I think this is actually maybe the dark horse that not everybody is considering, and that is corporations now have acquired 1% of the ETH supply. This is coming in from Standard Chartered talking about this. And there's a few points here. ETH-focused treasury firms, they've kind of doubled their pace of investments, but now we're starting to see companies. And I think this is a global phenomenon that companies are going to start to treasury assets. In many cases, you can already start to do that here in the US with changing accounting laws. And you're looking at companies who are looking at maybe what is the next Bitcoin kind of thing. And this is something that I think will continue to push forward, especially if ETH and the ecosystem starts to create more value around payment systems and all the different kinds of scenarios that play out within the ETH ecosystem. Corporations could reach 10% of all ETH. Put that in your head for a second. Corporations holding 10% of one of the biggest blockchain ecosystems out there. Imagine what they would look at if that continues to climb in terms of future projections to hold it, future projections to build on it, and also the capacity to possibly go into other ecosystems around it. This could get into a very major play that starts to set up all this stuff. So very positive for what's going on in the ETH ecosystem. I still think we are in the right direction for the Fed fund rate. Whether or not Chair Powell believes that or not, we'll find out tomorrow, so make sure and tune in for the live stream. Again, if you're not in the Diamond Circle, make sure and join that now. It's very easy. It's a link down below. And of course, follow me out there on X @Paul Barron. We'll catch you next time right here on The Paul Barron Show.